Real estate finance introduction. Financing is perhaps the most misunderstood part of a real estate transaction. Just the terminology can throw the average citizen for a loop. The borrower is normally referred to as the mortgagor, while the lender is referred to as the mortgagee. While in some states there's a third party involved who holds title, in most areas the lender, mortgagee, takes a lien on the property, the collateral, to secure the loan or note that the borrower, mortgagor, receives. It's a voluntary agreement by both parties where each agrees to certain terms and conditions. There are, however, lots of fancy legal terms to explain the basic agreements. For instance, the word hypothecation describes a normal everyday loan because the property is the collateral, but the borrower gets to use the property as long as they continue making their payments. The borrower is promising to pay back the loan, so the document they sign pledging this is commonly referred to as promissory note. It's really nothing more than a sheet of paper that can be sold or assigned to anyone else. Granted, it's backed up by the value of the real estate, but as anyone who's ever been owed money will tell you, lending is much easier than collecting money. There are legal requirements that lenders must follow. Even your local loan shark is technically prohibited by law from doing certain things. Normally, interest rates on most mortgages are not capped, but there are times and certain loans where a maximum interest rate exists. These laws are known as usury laws. The word is derived from the Latin word meaning interest, and more recently it refers to charging excessive interest. Of course, what's excessive to one person is another person's income, but state laws can be very specific on maximum allowable interest charges. There's a reason banks and credit card companies are located in certain states, because based on court rulings, they can use their home state's rules instead of the state the borrower lives in. It's difficult for any entity to effectively regulate interest rates because each borrower is different in terms of creditworthiness and credit scores. In addition, interest rates are only one factor. Many mortgage lenders charge origination fees or points for processing a loan. A point is 1% of the loan amount. So if a borrower pays 1 point on a $200,000 loan, that's a fee of $2,000. Why would anyone pay points? It can make sense financially because the lender may reduce the interest rate. It's really a pay me now or pay me later situation, but it only makes sense if the borrower plans on keeping the loan for an extended period of time so they can recoup the extra upfront expenses. Where exactly does the money for a loan come from? Obviously, as your mother and father told you growing up, it doesn't grow on trees. But where does the lender get the money? There are three major components to real estate financing, with the first being the Federal Reserve, the Fed. They print money and set the rules and policies on how lenders must operate and the reserves they must keep on hand. They also regulate the flow of money in the economy. A basic explanation would be they print or make more money available when the economy needs help, and they do the opposite when the economy is doing great and inflation or increasing prices start occurring. How successful they do their jobs will be debated until the end of time, but our current economic system is now dependent on them more so than ever before because they've been extremely proactive or involved in decisions beyond historic norms. The second component of financing is the primary mortgage market. This can be thought of as who actually provides the money for any loans. Mortgages and notes are bought and sold, so when you walk into a local bank or mortgage company, it's conceivable they are just the middle person for the loan and are actually lending you someone else's money. The money could be coming from larger banks, insurance companies, pension funds, or other sources. The third component of the financial system deals with the buying and selling of loans after they have been completed and the funding provided. The secondary mortgage market allows the primary lenders to free up their cash so they can continue funding other loans. The largest participants in the secondary market have been Fannie Mae and Freddie Mac. These were created by the federal government and are sometimes referred to as GSEs, government-sponsored enterprises. Essentially, each became a pseudo-private enterprise that issued stock. Today, they are basically controlled by the federal government because due to massive losses, they were placed in a conservatorship in 2008. The way it was supposed to work was they would buy huge pools of mortgages and then sell securities to large investors using the underlying mortgages as security. In the past, the difference between the two was that Freddie Mac did not provide guarantees the mortgages would be paid, but they each became highly leveraged and unable to handle large losses as real estate prices declined. Due to few limits on the liabilities of guaranteed payments, the total bailout cost is almost impossible to measure, but it's conceivable losses could easily reach $500 billion or higher. One of our original points was that it's more difficult to collect money than to lend it, but the exception to that rule is when the government is backing the loan or the securities, at least until they run out of money as well. Technically, they really can't run out unless they run out of ink for the printers, but remember, the more money they print, the less it tends to buy. You probably know someone in your family who tells stories like, "When I was young, a Coke was only a nickel." Let's hope in a few years you don't need to break out a $100 bill when you're thirsty.